Halifax. Just some quick introductions. So my name's Steve Latimer. I'm a partner in our tax group here in Halifax. My practice focuses mainly on tax planning for private corporations, their stakeholders, anything we can do to save our clients money or help them defer tax as far into the future as possible. That's where I like to focus my time. And I'm here with James Nichols today. I'll let James do a quick introduction of himself.
I'm James Nichols. I'm a manager in our tax group, similar to Steve. Do a lot of the owner-manager tax planning. So work a lot with Steve and some of the other partners in our group. But yeah, excited to go through the proposed budget today.
Okay, so we were having a little bit of technical difficulties right off the bat. I think we've got those sorted out. So yeah, we're here to talk about the budget. We have an agenda for today. So we've got some personal tax measures that were in the budget, some business tax measures, some changes with respect to trusts, some international changes, some sales and excise tax changes, and then we also wanted to spend a little bit of time talking about what was not there and what that might mean for local businesses and their stakeholders. This is a disclaimer that our legal team makes us put in to every presentation. This information is accurate as of today. This budget is still proposed. It has not yet been formally approved and enacted. So the stuff that we're going to go over today is it's all in draft legislation right now. Depending on what happens with that budget, it may or may not become actual legislation. But we just wanted to make everybody aware of what's in the current budget as it stands today. Just a quick quote to lighten things up after reading a disclaimer. This was from Milton Friedman. If you put the federal government in charge of the Sahara Desert, in 5 years, there'd be a shortage of sand. And we don't like to take sides with any political organization, but it's kind of funny that we talk about budgets and fiscal responsibility, and yet the deficit seems to continue to expand. And we're talking about putting a lot of investment into great spots for the Canadian economy. So hopefully we see the benefit of that. With that, I'll pass it over to James to go over the personal tax measures that we saw in this year's budget.
And you have full control of the slide deck. I can't change slides, so I'll just give you a little prompt. But like Steve said, I'm going to go through some of the personal tax measures. There wasn't a lot in the budget as it relates to personal tax measures. This is a quick one for some of those one-on-one care workers. They have a new proposed tax credit starting in 2026. You can read the slide a little bit more to get some more details, but we'll move over to the next one. This is a change in some of the non-refundable tax credits. So there's a reduction in the rate used to calculate non-refundable tax credits. Previously, it was always the lowest marginal rate, and they're looking to explore reducing this rate to 14.5% for 2025 and reduced to 14% in 2026 in subsequent years. So it's kind of a phase-in approach starting in 25, and then we'll continue on over the next 2 years. And then this is a slight change in some of our qualified investments for registered plans. So they've expanded some of the things that registered disability savings plans can invest in. They've reduced what all registered plans can invest in. So some more niche type of investments for those registered plans. And these amendments are going to be applicable on or after January 1st, 2027. Then the home accessibility tax credit. So this is a tax credit people would have got for trying to make their homes more accessible due to a disability. Some people were claiming these tax credits under both the home accessibility tax credit and medical expenses tax credit. Now, starting on taxation years in 2026, those accessibility expenses are only going to be allowed to be claimed under one of those two programs. And then on to the carbon rebate program. So this was something that was already being phased out, and just a little tidbit that they're not going to do any adjustments to those rebates for adjustments filed after October 30th, 2026. So most of us have already stopped receiving those carbon rebate checks, but just a little additional piece for that. And then this is the last big thing for personal tax measures. They're introducing a automatic federal income tax filing system for low income individuals. This is more so to make sure those low income individuals have access to certain credits and benefits that would otherwise go unclaimed due to them not filing their tax returns. So CRA is going to start automatically filing some tax returns for those low income individuals, being people that have taxable income below the lower of the federal or provincial basic personal amount. And then I'll pass it back over to Steve for some corporate tax measures.
Yeah, thanks, James. So I think the biggest thing that I saw for Canadian businesses in this budget was the change, or the proposed change, with respect to immediate expensing for manufacturing and processing buildings. So what they are proposing in this budget is a temporary 100% deduction for the cost of eligible manufacturing and processing buildings. In order to qualify, at least 90% of the square footage of the building needs to be used in the manufacturing and processing of goods for sale or for lease. There's some other conditions in there as well. But the difference this is compared to the current rules, under the current rules, the maximum deduction per year is 10%. And now we're looking at a 100% deduction. So when the government is talking about trying to create investment in Canadian jobs and Canadian manufacturing, I think this is an example of them putting their money where their mouth is. And I'd love to see this one come through. I think this would be great for local businesses that are expanding into the manufacturing space. This will qualify for both new and used buildings as long as they're purchased from a non-arm's length party. So you can't sell a building from one company that you own to another company or within a related group. But as long as it's acquired from a non-arm's length third party, it does not need to be a brand new build. If there is a subsequent change and that building is no longer used in manufacturing and processing, the accelerated amounts of the CCA tax deductions that were available in the first years would be recaptured into income. So it would create a large taxable income inclusion for those businesses. So this is great for businesses that are looking to spend a long time in manufacturing and processing. If a business was going to purchase a building knowing that it was going to repurpose it in a couple of years, we may want to consider whether or not we take advantage of that full deduction. It's an elective deduction. You don't have to take it. But it could be quite punitive to change from manufacturing and processing to another purpose. This deduction, if the budget passes, will be available for properties acquired on or after November 4th of 2025. The next one here is they're looking to crack down on the tax deferral available through a tiered corporate structure. So if a corporation in Canada earns passive income, part of that income is a permanent tax, and another part of that income is called a refundable tax that the company will get back if it pays sufficient dividends to its shareholders.
Looks like we're just having some technical difficulties there. Just 1 second.
James, can you hear me?
Yeah.
Okay, my Zoom crashed and now my video is not restarting. Let's see. Sorry, folks. Okay, maybe we'll proceed without video. Just in the interest of everyone's time, I'll try to get that deck back up on screen again. James, can you let me know if that comes up?
It's coming up on my end. See if I can share it on my side.
Technology is great when it works, but it is frustrating when it doesn't.
Can everybody see that?
I can see it. It's not in presentation mode, but I can't see it.
Yeah,
You don't see the slides?
We
see the slides.
It's just not full presenter view, but that's okay. We can go with that. Looks good.
Oh, weird. Okay. We're back on your tax deferral through tiered corporate structure slide there, Steve.
Yeah, I was on slide 15. If you want to advance to slide 15.
Yeah.
I'm not sure if everyone can see slide 15. I'm just seeing this, the title slide right now. There we go. Okay, sorry about that. So like I was saying, if a company earns passive income, part of it is a permanent tax and part is a refundable tax that the corporation can get back if it pays sufficient dividends to its shareholders. The government had concerns with certain structures the taxpayers were putting in place that would allow for a bunch of stacked corporations to pay that dividend up a level and continue to access the deferral. So really, if it's paid from one company to another connected company, there could be a deferral opportunity without having to pay any personal tax. These structures were not very common. It's not something that we saw a lot of, but it is something that the government is perceiving to be abusive and looking to crack down on for structures and dividends paid on or after November 4th of 2025. The next one here is patronage dividends on shares from agricultural cooperatives. This is very niche. It only applies to farming businesses, but certain farming businesses will have an equity ownership in different types of cooperatives where they may buy their inputs, whether that's feeds or feed or seed or any of their inputs for their farming operation. And really what this rule is intended to do is extend planning such that they don't have to pay tax if they're receiving additional shares from those cooperatives. The next thing that we're seeing here, which is another very welcome change, this is a change with respect to the SR&ED incentives. This is a program that's been in existence for a number of years now, but the change that they're looking at making is increasing the expenditure limit on the enhanced credit to $6 million when it was formerly $3 million. So the enhanced credit is 35%. If the budget does move forward and that top limit increases to $6 million, that would now result in a maximum credit for businesses of up to $2.1 million, which is 35% of $6 million, essentially doubling it from $1.5 million currently. We'll go on to the next slide there, James. They're also talking about implementing some administrative relief. There's a lot going on here, but if this is implemented, as of April 1st, 2026, CRA will have a new pre-claim approval process where before a business invests all the money and incurs the costs for a project that they think may be eligible for SR&ED, they can submit a pre-claim submission. And CRA is saying that they are going to reduce the review time down to 90 days. So that would allow someone to, like I said, submit what they're planning on doing, and within 90 days, know whether or not CRA is going to agree that those expenditures are eligible for SR&ED. And for a lot of businesses that are doing startup and new development, it's, these SR&ED credits are crucial to the economics of a potential project. So knowing in advance whether or not they'll qualify is a great thing. And the quicker that we can get that confirmation back from the government, the better. The next one here, the government is proposing to enhance the clean economy tax incentive. So this is very similar to some of the things that the previous Liberal government rolled out, trying to create tax incentives for businesses that are either manufacturing in a clean way or working to capture carbon or produce clean electricity. All of these would apply on or after November 4th if the budget is approved, which is great to see. The next one that we have there is critical mineral exploration tax credit. I won't spend a whole lot of time on these next two. These are very niche investments that are related mostly to different types of flow-through investments. Basically, what they would allow is for an investor to purchase shares of a corporation that is doing mining or exploration, and deductions that would be available to the mining corporation can actually flow right through onto the personal tax return of the individual investor. The one caution with these types of investments is it's very dependent on the activities of the corporation that you're investing in. So the investor does take some risk. If everything goes well, there are very large deductions available, but it's really fact specific, and you'd really want to consider the economics of that investment before moving forward. James, maybe we'll skip right down to 22, please. This one is just a heads up. So the government has said for a number of years now that if a business is paying independent contractors as opposed to employees, they want to know about that on a T4A slip. The threshold for this is supposed to be if you pay an independent contractor anything more than $500, you're supposed to be filing this T4A slip. For years, the CRA has had an administrative policy that they're not enforcing penalties for not filing these forms. However, the 2025 budget is saying that they are going to start looking at this much more carefully. They're going to provide more funding for the CRA to implement a compliance program that addresses this. CRA's concern here is with the quote-unquote gig economy, that there's a lot of contractors that may be earning income that's not getting properly reported on the various tax returns. So this is a measure that CRA is taking to try to crack down on that. And now I'll pass it over to James to talk about some trust tax measures.
Thanks, Steve. And this will give you some time to get your camera figured out. So yeah, the budget had a few different trust tax measures, but primarily what they were doing were broadening some of the anti-avoidance rules relating to the 21-year rule. And for those that don't know, trusts are a mechanism set up more or less to be able to defer tax generationally from one generation to the next. But there is a lot of other uses for them. And the purpose of that 21-year rule is to enforce a deemed disposition of any trust assets after 21 years. So there's been rules that have come out recently. The current rules prevent taxpayers from transferring assets in a trust directly to a new trust that was settled at a later date, to essentially kick that 21-year rule down the road a little bit more. And the new anti-avoidance rules have been expanded to include indirect transfers. So as a little example, we have this chart here. And in this example, Trust A, or Old Trust, was settled prior to Trust B. Trust A owns property, and Trust B owns shares of a Canadian corporation. And in this example, Trust A is rolling its property under 107 sub 2 over to Canco, which is a corporate beneficiary of Trust A. And essentially what this does is it defers the deemed disposition of that property, so deferring the tax on that property, over to Trust B's 21-year rule. So what these new anti-avoidance rules are set up and what they're meant to do is to essentially make Trust B's 21-year rule the same date as Trust A's for the property that it transferred over. So what these new anti-avoidance rules are meant to do is just stop people from being able to kick the 21 years down the road. So you can't just settle a new trust 20 years after you set up the first one and then get a 41-year deferral. The other proposed rules, so they've broadened some exemptions for Schedule 15. Some of you might remember 2 years ago, I think it was, your accountant's probably reaching out to you or you reaching out to your clients about trying to get all the settler, trustee, beneficiary information for all their trusts. So they've expanded what some of the exemptions are for filing Schedule 15. So stay tuned for what some of those changes are. And then the other big shift or new amendment is they're pushing down the reporting for bare trusts again. So I think this is the third time in a row or back to back where they've continued to push down the reporting requirements for bare trusts. There was the expectation that they were going to have to start filing for year ends on or after December 31st, 2025, but this has been pushed into 2026. And then we are back to Steve for some international tax measures.
Thanks, James. So there's a number of slides here. I'm just going to speak to the first one, just in the interest of everybody's time, because the international measures are not as widely applicable as some other things. But the Canadian tax system has what's referred to as the transfer pricing rules, and what they're intended to do is to make sure that if one business is paying expenses to a non-arm's length business that is outside of the country, that those transactions are being appropriately valued for tax purposes. And really what Canada wants to do is make sure that the Canadian tax system is not being unfairly gained by having expenses deducted against Canadian taxable income and the revenue associated with those expenses being taxed in a low or no tax foreign jurisdiction. The really important things to remember here is if you have a business that is paying expenses to a related business that is outside of Canada, there are specific reporting requirements associated with that. Like I said, the transactions need to be valued at fair market value. And if the aggregate of those transactions is over $1 million, then there is a form that needs to be filed with the CRA. You have to file a T106 to report those activities to the CRA so that they have the option to review them if they want. There can be pretty significant penalties for not filing and not aligning with these rules. Like I said, these rules are very complex. If you are doing significant amounts of cross-border transactions with related parties, I'd strongly recommend using a transfer pricing specialist just to make sure that you're not exposing yourself to any unnecessary risk. And James, I think I'll pass it quickly back over to you for a little bit of sales tax.
So similar to Steve, there's a handful of changes to sales tax that I probably won't be very applicable to many people. So I'll go through some of the more applicable ones. The first being the underused housing tax. Again, this is one of those things that were implemented similar to the time that Bear Trusts were implemented, and they're proposing that they get rid of underused housing tax. So there'll still be the obligation to complete those filings from 2022 to 2024, but from 2025 onwards, underused housing tax filings will not need to be completed. UHT was a program implemented that was meant to essentially tax underused housing, but I think this was one of those programs that they had put in that ended up being more costly to the government than the revenue that it actually ended up bringing in, and created a lot of administrative burden for a lot of those real estate owners, whether they were Canadian or underused or not. So this is a welcome change for us for sure. The other item is the change in luxury tax. So this was what me and Steve were joking about earlier, but basically what they've done is they've removed luxury tax on aircraft and boats, but not on cars over $100,000. So if you bought a plane last year, you should have held off and bought it this year. There wouldn't have been any luxury tax, but your $100,000 Ford F-150, you're still going to be paying your luxury tax on that. So just a small change, and I do think this was the change made just because, similar to UHT, it was more expensive to administer than what it was bringing in, but a change nonetheless. The last thing that I wanted to talk about from sales tax perspective is just the GST rebate on housing for first-time home buyers. So they're eliminating GST on new homes for first-time home buyers valued at less than $1 million, and it's a reduced GST for first-time home buyers on homes less than $1.5 million. And then I'm going to pass it back to Steve to talk through some of the previously announced measures.
Actually, James, let's just skip over these because it's still in a proposed state. Oh, your deck doesn't have the not in the budget piece.
Oh yeah, here I can bring that up. Just give me 1 second.
Okay, yeah, sorry everybody. We were having some technical difficulties here, and we weren't able to show the deck appropriately on my computer. Okay, thanks, James. So there were a couple of notable things that we did not see in this budget. The first one was a change to alternative minimum tax. We also didn't see any significant changes to either corporate or personal tax rates, excluding the small adjustment to the base credits at the very lowest income brackets. And the other thing that we didn't see was any clarification or softening of the excessive interest and financing expense limitations, the EIFEL rules. I'll kind of talk to these in a little bit of a reverse order here. The EIFEL rules, these rules were put in place. Again, the government said their intention here was to prevent income from deductions against Canadian income that they felt was unfair. And when it was originally announced, they said it was going to target interest that was being paid outside of the country. The legislation actually catches a lot more businesses than what they had originally discussed. And one thing that we were really hoping to see in this budget was some clarification around some of the exceptions to these rules. In particular, there's one exception called the domestic exception that, when you hear domestic, you think a Canadian exception. So you would think that if it was a Canadian company paying interest to a Canadian party, hopefully you'd meet that exception. But unfortunately, if that company is owned by a family trust and beneficiaries of that family trust are non-residents, you may not meet that exception. There was a lot of detail required to meet that domestic exception. So we were really hoping for some clarification on cleaning up some of that stuff that unfortunately didn't come. Excuse me. On to the alternative minimum tax, and James, maybe you can advance the slide for me. So some of you may have heard there was some concern leading up to the budget that the government may seek to apply alternative minimum tax on payments made out of a capital dividend account or a CDA account for a corporation. So what we wanted to do here is just illustrate what AMT is. The AMT, or the alternative minimum tax rules, were significantly changed over the last couple of years. And if we look at this example here, the top marginal rate for a capital gain in Nova Scotia is supposed to be 27%. But what happens if an individual actually has a large personal capital gain? So if an individual recognized a $25 million capital gain, they would have their basic tax, which would approximate that 27% of $6.7 million. But they're also going to get hit now with alternative minimum tax, or AMT, of almost $1.6 million, bringing the total tax up to $8.3 million, which as a percentage of 25 million would be an effective tax rate of 33%, which is much higher than what our tax rate is supposed to be. Alternative minimum tax is a refundable tax that you can get back over the next 7 years if you have sufficient taxable income. However, on these large one-time capital gains, for example, if someone was to sell a business, if you have $1.6 million of AMT, your likelihood of getting that back is very, very low, and that will become a permanent tax, pushing that tax rate up to close to 33%. If we move on to the next slide, what would happen if that same gain was realized in a corporation? So if instead of having that gain on a personal tax return, if we were able to restructure things so that that capital gain was reported on a corporate tax return, we had the same $25 million capital gain. Our initial corporate tax is $6.5 million, or close to $6.6 million. And like I mentioned earlier when I was talking about the refundable taxes, there's an available dividend refund here that if the corporation pays dividends to its shareholders, the corporation could get up to $3.8 million back in the form of a dividend refund, reducing the net corporate tax to $2.75 million. Half of that capital gain would go into the company's capital dividend account. So that would be $12.5 million that could be paid out of the corporation tax-free to the individual shareholders. And what we're seeing here is the tax savings in year one is only $129,000 on a $25 million capital gain, which, on its own does not sound like that much of a savings. However, when we look at the future dividend refunds here, that we could potentially get $3.8 million of additional taxes back, this becomes very, very efficient tax planning. And this was the rumor. I think this is what stirred up the rumor around CRA trying to put a tax on capital dividends, because people were planning into these structures to realize their capital gains corporately to get a more effective tax rate. And they were thinking if AMT was applied to that $12.5 million tax-free capital dividend, that would make this structure less tax efficient and quote unquote equalize the playing field between a personal and a corporate capital gain. So the moral of the story here is anytime that we can keep funds reinvested in a corporation, generally speaking, we're going to see very large deferrals in tax. And the longer that we can defer that tax, the longer that we can get investment returns on those deferred taxes and generate additional wealth. When it comes down to the dividend refund, in order to get the dividend refund, the company has to pay a dividend to a shareholder. If the shareholder is an individual, as long as those dividends are being paid to an individual with taxable income of around $250,000 or less, the personal tax associated with the dividend is less than the corporate tax savings from the dividend refund. So netting out to a very favorable cash tax position for the company and its shareholders. James, our last slide there. Just have an example of the personal and corporate tax rates across the Atlantic provinces. And what we can see here is the personal rates vary between 52% and up as high as 54% here in Nova Scotia. However, if that income was earned in a corporation that was subject to the small business deduction, the rate applicable could be as low as 10% PEI 10.5 here in Nova Scotia, and 11.5 in New Brunswick and Newfoundland. So what we can see is there's huge deferral opportunities to having that income earned inside of a corporation as opposed to having it on a personal tax return. And if the company, for some reason, wasn't able to access a small business deduction and it had to pay tax at the general rate, the tax rate is still between 29 and 30%. So there's a huge deferral opportunity still. And it really demonstrates the benefit of earning your income inside of a corporation. That is everything that we had wanted to discuss. We can now open it up. If there is any questions that the group has, they can. I'm not sure if the chat feature is the best way to monitor the questions, or if anyone can just unmute themselves and ask a question. But we can't ask, or we can't answer any questions specific to an individual tax filing. But if there's broad questions, we're happy to try to address those.
You could pop the questions in the chat, or feel free to raise your hand and we'll unmute you, and we'll just keep an eye on the questions here for a couple moments. Okay, seeing no questions in the chat nor hands raised. So I think we'll say thank you to Steve and James for popping on and giving us this fantastic budget review. We really appreciate it. We did make a recording and is streaming live on Facebook as well if you want to share it with anyone who couldn't make it today. Thank you all for joining us this morning, and we look forward to seeing you all again soon. Thank you to Doane Grant Thornton. We appreciate you doing this morning.
Yeah, thanks a lot for having us. We really appreciate the time. If anyone has any questions in the future, we are happy to try to help. Sorry for the technology issues. Unfortunately, all these systems are still not, you'd think after using them so much over COVID we'd be used to them by now, but sometimes we still have issues. But anyway, thanks a lot, everybody. I hope everyone has a great day.
Thanks, everybody.
Thanks, everyone.